Take a look at this gold stock, NGD. I caught 5 different trades on it. 4 winners, 1 was a loser. The total result? If a person risked $1,000 per trade, they would have made $9,000 in just 1 month. And here's the crazy part. You only need to check the charts once a day using just one set of moving averages. No complex indicators, no staring at screens all day. I've spent over half a decade studying the most successful traders in the world, and they all share one secret. They get one simple strategy, master it, and make sure it works consistently. Today, I'm going to show you one of my favorite stock strategies, the 50-day moving average bounce play. You will learn why this strategy works 80% of the time when done correctly, the exact rules I use to enter and exit trades, and how to turn a 20% move into a 100% gain, and most importantly, when to avoid this strategy completely. This is not just a theory. I'll show you real trades from gold stocks, China stocks, and Argentina stocks, and the USA stock market that proves that this strategy works across every market. Let's dive in. So I'll first go through some of our recent winners. One is CLS stock 2024. For every dollar you risked, the reward was $4. We see the stock moving towards a 50-day, then it bounces correctly and do a 30% move. There is NVDA, and here I show you the several trades you could have done in NVIDIA's 200% run. So we see 11% gain that we could have gotten there, a 40% gain, a 15% gain, which is a different strategy, which I showed in another video. And we see another 30%, which is that different strategy. But today we'll be focusing on the 50-day bounce play. We also see CRS, which is an industrial stock. For every dollar we risked, we could have made $7. And we see another profitable trade where we could have gotten a 20% gain. We see it in financial stock called TRAP. For every dollar we risked, we could have gotten $4 back. So if you risk $1,000 in this trade, you would have gotten $4,000. This setup is great, and I love it because it gives you safety of account. You can avoid market downturns because since you're only in the market for the quick upswings, you're always going to be making profit when those upswings come. You have very quick gains. You don't have to wait 3 months to make 30%. As I already showed you, you'll only be making it in 2 weeks because a lot of the time stocks are sitting. So you're only getting in while the stocks are going up. So you don't waste your time while the stock is sitting through the corrections. And of course, this helps you compound your money quickly. You're not going to be getting those 200% moves, but you'll be getting so many 20 to 40% moves that you can even make more ground than somebody who got a 200% move. Now, of course, since you're trying to time the market and time the stock, this means that this is a lot of work. It has a lot of homework and study that you have to do. You have to understand the technical knowledge. You have to be updating and finding new trades. But I do that for premium subscribers in my newsletter. Of course, I do find the trades for you. All you have to do is just sit back and buy. But of course, it is helpful if you understand the fundamentals behind. You can also be easily whipsawed in a market if you don't know what you're doing because you're going in and out of trades. This is something a beginner who is not trained can suffer with. The commission can be costly. So of course, since you're taking many trades, you're going to be paying more commission. So it would be better if you find a commission-free brokerage. And of course, since we are getting this 40% move, these quick moves, we're not going to be getting those 300% moves. So since this is a trade that is within the market cycle, it is not the whole market cycle. Investors are the ones who can enjoy those huge returns. But this strategy makes up for that by getting these returns very quickly, and then you can easily compound your account. So the first thing you want to do is gain technical mastery. The first thing that we are looking for is something called a closing price reversal. So here I show you closing price reversals, which were taught by the legendary George Land, the person who found out about stochastics. He invented the stochastics indicator. And I did not want to change his work, so I just literally got his work and I shared it with you because this is where I originally learned it from. The first one is a strong sign. We make a new low on the trade and we are reversing the trend, but the close is not above the close of the other high. This one I always try to avoid it. I like part B, which is stronger, where we do not make a new low. We do not close over the high of the previous day. This is a stronger sign. It's also an inside day for those who know technical analysis, and I really like this one. The next is when we make a new low and we override the previous red bar and we close above the high of the previous day. And then the fourth one, which is the strongest, is we don't make a new low We have a higher low, and then we close above the high of the previous day. So in short, the ones which I really like are the ones which don't make a new low, and the ones which close above the high of the previous day. I'm always looking for two things. Either an inside day, which is this, which is right here, which is my option B, or I'm looking for a close above the previous day's high, which is what we can see here. The first one, I always try to avoid it, but it is still a valid way to know. So you have to master these 6 reversals. When you're trading on the market, you don't have time to look through everything. The easiest way to know is that if I get a close above the high of the previous day, that's my first indicator that I'm looking for. The second thing is if I have an inside day, this is also a very good sign. So after the closing price reversals, then we have pattern recognition criteria. And to help us, we need to have a good chart setup. We want to have our weekly chart set up and our daily chart. We always want to look at the bigger time frame to see the bigger picture of things, and we want to be looking at the shorter time frame to help us know exactly when to enter. On the bigger time frame, on the weekly chart, we have the 10-week simple moving average and the 30-week simple moving average. And also we'll put our earnings table. On the daily chart, we're going to have a 20 exponential moving average and the 50-day simple moving average. And we always want to be in sync with the market. So the markets that we could be following for this particular strategy is we could be following the USA market, or we could follow the foreign markets like China stocks, because China stocks might have stocks on the USA market too that we can trade from there. Alibaba can be traded from the USA market too. You don't have to go to China and beg them to trade stocks from there. There is commodities, there is ETFs. So we always just want to keep track of the weekly charts of these ETFs. And this is a very simple job. It normally takes 20 minutes per day to keep track of all of these markets. There are other things which would be helpful to know, but you don't need to know them. This could be Elliott wave patterns. If you know them, that is helpful. But if you don't, that doesn't really matter a lot. Cheats, which is what I'm going to teach you later on. Double bottoms, you'll see those. We like to see shakeouts, all-time highs, good earnings. I'm going to show you those later in the video. So the golden moving average setup, I showed you 20-day exponential moving average, 50-day simple moving average. On a daily chart, weekly chart, we know what to put there. And we are always looking for stocks that bounce off the 50-day and the 150-day simple moving averages during the weekly uptrend. Here we see NVDA, which made a 6-month base and then did a 190% move in just 5 months. So we see that it formed something called a virtual contraction pattern. Some people will call it a cup and handle. A lot of people come up with all different names, but the important thing is not to master the names, but to understand the psychology of what is happening. So we see bigger lows going in here, then it contracts, so people are not willing to sell. We see very tight volume action, and it breaks out on huge volume and does a big move. The fundamentals for this stock were also really good, so that made it better. And on the daily chart, this consolidation here is this upper consolidation here. I just showed you that. NVIDIA, this was an example of the daily chart. Appfolio, this is an example of what your weekly chart should be looking like. So we have the return on equity. So these are earnings. You want to have your earnings table here so that you can easily see if the stock is having superior earnings or not. Then, of course, add your moving averages, which I'm not showing in this chart. But our primary goal in this strategy is to always, I can't stress this enough, always watch the primary market. And I've told you what the primary markets are. It could be a stock index, it could be a commodity market, it could be a forex, it could be sector and industry ETFs. So what we're trying to do is that we watch the primary market. When the primary market sets up, then we go deeper into the primary market and see which particular parts of those primary markets are moving. So if the S&P 500 is showing a strong signal, then we look which stocks in the S&P 500 are strongest to buy. If China stocks are showing a strong signal, we do the same. If gold is showing a strong signal, we go deep and we look into which gold stocks are the best to move on, as I'm going to show you later in the video. So when the primary market shows a signal, look into the market. Do you see some Elliott wave patterns? Is it complete? That's a good sign. Are you seeing a cheat? Is there a tight price action? Is there a volume dry up? That is a very good sign too. Are you seeing double bottoms? Are you seeing shakeouts? That's a good sign. Is the stock going to all-time highs? Is the stock having great fundamentals? Those are good signs too. Sometimes we have them, sometimes we do not. So this is what a cheat is. This is something I learned from Mark Minervini. It only occurs in some stocks, and it is the earliest point where he tries to buy a stock. So we see a stock forming a base here, and then it formed this really tight price action. It's normally around the 20-day exponential moving average. I saw that. You don't want to be buying when the stock is overextended from that. As a swing trader, as an investor, you can, but as a swing trader, you don't want to be doing that because the risk and reward ratio become out of whack. And then we can see another cheat here, which is also something which they call a handle. And as soon as it breaks out, the person buys. So this was a very good example. So the handle normally happens in the upper third of the base, the mid cheat happens in the middle of the base, and the low cheat happens in the lower third of the base. So here we see another cheat in cause. This is in 2024, but I put a typo and I said 2010. You can see the price goes down here, and then it formed this really tight price action here. Volume dries up, and then it jumps out of here. This is the good buying. So sometimes it's not coming to bounce off the 50-day simple moving average. Sometimes it will come and then it forms a cheat and we just buy right above the cheat. So these are all variations of this 50-day simple moving average bounce pattern. So here we see an example in a crypto stock called CLS. A low cheat happens in the lower third of the base. So we see it coming down, forms this tight price action here. Breaks out, there's also good earnings. These are all good signs, and then it does a 170% move that you could have profited from. And I'm going to show you how you could do that, of course. So here is a trading strategy. Of course, we have to learn this theory before we go into the very beautiful examples that I have going for you later, because the examples are where you actually learn where to do it. These theories are important, so they're always in the back of your head, but the examples are where you're going to get it, and I'll go through each and every one of them in detail. Yeah, but before we get into it, if you want to see exactly how I analyze these setups, including patterns that led to winners like 240% in SMCI, 300% in Uplavin, 200% in NVDA, and 60% in HIM stock, which happened in just 2 weeks, I want you to go onto profitpunch.org and get our beginner-friendly investor guide that helped members make a 200% return on NVIDIA stock. It's all free. Sign up to the newsletter, check it out, learn the fundamentals, and if you like it, you can go for the premium version. I also spend over 20 hours each week researching these setups and also making a lot of research so that I can bring such videos to you. For example, this video took me a month to make, so if you really find value in this video, please hit that like button and subscribe to the channel. It helps me continue to create in-depth content and research like this. So the entry and exit rules. So you must know what is a risk to reward ratio. If you don't know that, please look around YouTube. You will learn. So risk to reward ratio in trading is normally how much are we risking to how much are we making. We don't care about absolute returns, because if a stock gives you a 5% return, but you're able to risk only 0.5%, that's a 1 to 10. While some stocks are going to give you 100% return, but you have to risk 20%. That is 1 to 5. So we normally don't care a lot about the absolute return. What we want to know is how much did the person risk to get that return. So for one risk, we normally want to be using 1.5 average true ranges of the last 14 days. This is used more as a maximum stop, and also I used it to measure where stocks are likely to go after. So this is a very important number. Keep it in your head. Also, how much percentage of your account are you risking? I will normally risk 0.3 to 1.5% of my account. The most common number that I risk is actually 0.4% of my account, right? It's because this particular strategy has so many opportunities in there. You could find yourself making over 20 to 30 trades per month. So you don't want to be risking a huge percentage of your account, because if it goes wrong and you're over leveraged, you're going to be hurt bad. So it's always important to risk little, because you're going to be having so many opportunities. But on very fundamentally great stocks like Meta, Google, NVIDIA, I will risk up to 1% of my account. But there's some traders out there who are able to risk up to 2%, so you can go for that. But I would recommend 0.3, start out there, to 1.5, because if things go bad, you're not going to be negatively affected. But if things go well, you will still get a good profit. Okay, so where shall we exit? I did some research, and this research took me about 3 months to make. But actually, it took me more like 5 years to understand even how to do this research. So I figured out that after a deep correction, remember 1 hour is 1.5 average true ranges of that stock. And a lot of these distances, I measured them just right above the 20 exponential moving average to the maximum point that the stock reached. So each of the stocks, I figured that after a deep correction in the market, in the primary market, like in the S&P 500 index, I realized that after a deep correction, the average stock will move 4.9 risks away from its 20 exponential moving average after having a good setup. So I studied all the valid setups, and I was like, where does it normally reach? But that doesn't matter what the average move is, because some stocks might do 11 risks, but others might do 2 risks. I think the most important number is, what did 80% of the stocks do? This is a very important number, because it helps you to know a consistent profit target that you should look for. So I figured that after a deep correction, good stocks which are showing good setups will normally move 4.5 risks away. And ETFs will move 3.5 risks away. Of course, we know why, because ETFs are a bunch of stocks, so there'll be some good and bad stocks in there. So it only makes sense that they have a lower number. So the average doesn't matter a lot. Median doesn't matter a lot. Think about what 80% does, because you're going to know that 80% of the time that this is what I expect. But after a shallow correction, I did research on different sectors in the market, and I found that most of the stocks will actually bounce 3 risks when the S&P 500 bounces off its 20-day. So this is very good information that you should keep track, and this is where we get our profit targets. 1 hour is equal to 1.5 average true ranges, and I'm going to show you how to use this information later. So these profit targets, of course, I try to keep it simple, because when you're trading on the day, you really don't have time to think about this table like I tried to show you here. You just need to think of a very quick number in your head that you can know where to put your profit target. So you just know 80% of the time we're going to get 3 hour. If it's a very deep correction, we know we can aim to get 4.5 hour 80% of the time. This play works best when the S&P 500 has bounced off its 20-day or after it has gone through a very deep correction. So if the market is extended, please try to avoid this play. Now that we have our profit targets, I also wanted to let you know that this is a very simple play within the whole stock market cycle. So don't try to be getting 300% gains from this particular play, because the stock market cycle involves the stocks going up and down, up and down. So here you see we have a shakeout in the rally, which is something I could have traded here. So you could have gotten an 11% return there. You could get 40% return here, but then you are not going to enjoy this other gap up plays because it would have been too risky for you to enter. You would need to know another stock strategy to profit from them. While an investor would have just bought it here at $50 and they would just sit through this whole thing without having to conduct all of this trade. So you always want to know the advantages and the disadvantages of your strategy. So for us who are doing this play, we cannot enjoy this 200% gains. We're only going to be getting this 11% gain, this 40% gain, right? But the good news is that we can always get thousands of stocks that are going to be doing this play. While in the whole year, only a few handful of stocks are going to be moving 200% up. So the investor also has that risk that very few stocks of his are actually going to be making this huge move. But for us, we know that almost every stock, we can always profit from it. So here are some very important lessons from my research, and I want you to put this in your prefrontal cortex. The first thing is that the first correction after a big breakout, the first 20 and 50 moving average correction after a breakout is a great buy, especially from a big base. So this is something I realized while I was doing my research. After a breakout from a big correction, a 20-day exponential moving average is a better selling guide than a 10-day exponential moving average, because I found that a lot of these stocks, while they were making this move, none of them closed under the 20-day exponential moving average. So that could also be another selling guide if a stock has broken out from a big base. Like here we see NVDA broke out of like an 8-month base with very huge volume. So here you could just use the 20-day simple moving average as a selling guide. And you could have gotten out easily like here. I realized that 90% of the stocks that I researched to move at least 3.5 risks, 100% of the moves started above the 20-day exponential moving average. So when the move is below the 20-day exponential moving average, that doesn't mean that it's going to fail, but there's a very high chance that it's not yet ready, because when you're trading, you have to get the stock, you have to get the timing. That is the price you pay as a trader. Investors don't have to pay this heavy price. 84% of moves never close under the 10-day exponential moving average. So if you get a close under the 10-day, there's an 80% chance that that move is pretty much finished and you should already be out. This should not even be happening. 100% of moves never closed under the 20-day exponential moving average. So whenever this happens, most likely the stock is setting up for another type of move. So you should not be in that stock. And of course, this strategy, when you're scanning for it, you're going to be getting so many stocks. So during a day, I might get over 200 options, and I need to pick out only 2. So how do I pick 2 out of 200? So I need to be looking for a stock which has very strong relative strength. I realize that the strongest stocks normally will make the bigger return. So let's say that it's June, right? And I find a stock which has moved only 20% from January to June, and another stock has moved 80% from January to June. You should always pick the stock which had already moved 80% because it's already showing huge momentum. Strong earnings, since we are looking in an industry chart, or maybe let's say we are looking for Chinese stocks, the first Chinese stock to move would normally also be the best in the pack. And of course, the stock which is closest to all-time highs is also a very good sign. And of course, the one with the greatest setup is also a very good sign. And when should you avoid these trades? Try to avoid biotech stocks, because since You're taking on a very small risk. It could be 4%. That means you could be using 15% of your account in a certain trade. Biotech stocks are known to just drop 50% the next day. So you don't want that to happen to you because you could just lose 5% of your account in one night. So try to avoid those stocks if you can. Avoid stocks around earnings because that is not that strategy. There's another earnings strategy video, but that is not the strategy. So when earnings are there, do not perform this trade. Do not perform it around news. You just want it when the stock is just normally moving. Also avoid stocks that trade less than 50 million US dollars over a week. This is because they can easily be manipulated by hedge funds. They can easily move the price. So you want a stock that is very, very liquid. You can get in and out. So this is how I actually trade this strategy. Step 1, watch the primary market. Step 2, watch the individual stocks in the primary market. So the primary market could be gold. So then I want to be watching gold stocks. But I never watch the gold stocks really. I just watch the gold itself. If the gold has set up, then I now take a look at gold stocks. So it's always very easy. Just look at gold, right? Then if gold has set up, look at the NVDA stocks. You want to see a 3 to 4 week correction on the weekly chart and it is setting up, right? Then you want to be buying a setup that is showing our closing price reversal or a cheat and it's very close to the 20-day exponential moving average. We set up our profit targets, right? When the stock moves one risk in our favor, we raise the stop to half the original risk, right? And then after the stock moves to 2 risks, we normally raise our stop to break even, and I will also sell half. Why do I do this? Because contrary to what a lot of people think, technical analysis has no proof. Even if I have figured out that stocks will normally move 3 risks away, I do not know it's going to happen this time. Maybe tomorrow is World War III and something wrong happens. We do not know the future, so we just sell half there to protect ourselves. And then I will sell another half at 3 risks, which is my second half. But of course, this will change under special circumstances. For instance, if I've just come from a very deep correction, I will maybe just wait to sell all of it at 4.5 risks as I showed you, right? But for a normal trade, this is how I would do it. So remember the profit targets we talked about. So I normally use 3R, but when it's a very deep correction, I will use 4 to 5R. The very good stocks can even move 9 risks away. But the more you do this strategy, the more you'll understand which stocks are going to be stronger. It's normally those with a very high relative strength. And then you're also going to realize that those weak stocks, they will not move as much. There's a very huge tendency of people to think that, hey, since the stock has been beaten down, let me buy it. But contrary to what a lot of people think, you should always be buying the one that's overextended as a trader. You want to be buying the one that has already moved up a lot. But I'm going to show you that in the examples, of course. So this is a trade plan breakdown. Step 1. I use 1.5 average true ranges to see where my maximum stop would be. Then I put 2 risks and I'm going to sell half there. I put 3R to be knowing. So you see here 3R, this is where I expected the stock to stop. And you see the stock actually was very close to that. It's quite interesting. This always happens a lot because I always question myself for half a decade. I'm like, where do the stocks move? Where do they always move to? But now I finally get a good idea. This is of course just kind of like a ballpark. But then after that, we see that this risk is too big. We just have our profit targets, but the fact is that we don't have to wait for the stock to fall all the way down here, right, to know that we are wrong. Ideally, you want the stop to be right under that candle. So what I do now is that I've put my markings of where I expect the stock to go. Then now step 2, I adjust my risk. So since my risk is now small, that point where we show 3R is now no longer 3 risks profit. For example, in this example, it is 4.4 risks. So if I risk $100, I know I'm going to be getting $440. If I risk $1,000, I'm going to be getting $4,400, right? So those are my profit targets and I know what to do. Of course, members of my newsletters, you just need to know this theory, and then for me, I'll be telling you when the setups are there. And now we go into the gold stocks example, and you'll see how to make 100% profit from just a 20% move. So the primary market is gold, and the secondary markets that we shall be looking at are gold ETFs, gold stocks that I've listed here. So here I show you the primary market, and every time it was bouncing off the 20-day simple moving average over this period of time. So we see here 1, 2, 3, 4. Very good signs in the primary market. And now we go to the secondary market. So whenever you see these kind of signs, then you go into the secondary market and you're like, hey, what are you doing? Because the secondary markets are going to be having way beautiful setups because the primary market is just so big that it cannot have such easy setups for us to trade. So we go into the secondary market. So here you can see for those particular bounces, these are the trades that we could have gotten. So we see trade 1, we see it correcting, we see at least a 3 to 4 week correction. That's nice. We see kind of like a small cheat here. As soon as it jumps over the 20-day, we see all our closing price reversals that I told you about. It forms kind of like a mini cheat, right? As soon as it jumps above that cheat, we go into trade 1. And then this first trade, we could have gotten a 5 to 1 risk to reward return. Trade 2, actually, let me go to the actual chart just a second. So this is a 3 times leveraged gold miners ETF. So for trade 1, we saw what could have happened. We see a small cheat here. We wait for a 4-week consolidation. This one, we could have gotten a 4.85 maximum risk to reward ratio win. Then we go to trade 2. Our closing price reverses. The inside day is already here. Things already happened. So I normally want it to go above this high. I buy as soon as it crosses above the 20-day moving average. 4 to 1 risk to reward win. Of course, you might not get the whole thing. Maybe you might get 3. Here, I was just showing you the maximum win that you could have gotten. Here, the maximum win you could have gotten was about 3.5. This one didn't form 3 weeks, but I saw other gold stocks that had a 3-week correction. So I was like, oh, I should just get into the ETF too. And then here we have trade 4 as well. Then Ego stock. This is the gold stock. So here you see the examples. Trade 1, we wait for our 4-week correction. So I like this one because it actually formed something which we call a cheat, right? Very tight price action. The volume has reduced there, and then it jumps, it gaps out on that day. So whenever it gaps up on that day, I just buy it. And I know it should not cover the gaps. That was the first trade. Ka-ching, make your money. Next one, you see it from our closing price. So we get our correction 3 to 4 weeks right there. 1, 2, 3, 4. You can just count on the weekly chart. Easy to see. This first one was not, we didn't get it because it was too short. So don't trust those very short ones. You want to wait 3 to 4 weeks. And then it comes and forms something like a double bottom here, shakes out this first low. That's a very good sign. And then we have our closing price reversal inside day, like I told you, goes above the high. It first from this first inside day, so you could have waited to buy around here, but then it forms another inside day here again. So I just buy above the high there. And then here, 3 to 5, you get your win. Next one comes down, bounces off the 50-day simple moving average, which is kind of this black line. We get our closing price reversal down here, but I kind of want to wait for the stock to actually move above the 20-day exponential moving average. But if other stocks have already done it in the gold sector, I could actually just have bought here at 16.51. So you normally also want to be looking at other stocks in the same industry and see what they're doing. If other stocks have already moved, I'd actually have just bought here for a better return. 3.52 was your maximum possible profit. So here we see we get a close above the previous day high. We already talked about that. Of course, I wouldn't buy here since I don't trust it below. I'd have bought around here. And then here you could have gotten 2.5 to 1 trade. So that was a win for the people. NVDA stock, so this was the one which I used for the title of the video, forms a cheat. This one is acting stronger. You see the other one actually formed a cheat too, but it was below the 50-day. This one formed a cheat above the 50-day. We have your 3-hour profit here. Trade 2 does this. Trade 3, you make your profit. Trade 4, this one failed, right? That's why you're complaining about this 1 hour loss. Yet you could have made 3 plus 6.5, 10. And then you do -1, you could have still made a huge profit. So I wanted to show you that here, the trades don't work out all the time, but hey, don't worry because you're going to get another opportunity. Next stock are Argentina stocks. This one I'm not going to get so much into detail, but we have our primary market, which is the Argentina ETF. We see it forming huge checkout. You see, whenever you see these signs on a primary ETF, because an ETF is a collection of stocks, the more the securities that this ETF or index represents, the more potent the signal is. So this one maybe might have 20 stocks and it's an Argentina ETF. So all of those 20 stocks are showing this sign. We see a checkout here. These are institutional investors trying to check out very weak hands, So the retail traders, they get scared and these guys are just trying to scoop up the stock for themselves because they want to get it for cheap. So they cause a checkout, everybody sells, and then you see this price just goes up. So I kind of see this, right? You kind of have to look out for these signs. I see it going up, right? Immediately here, my spidey senses go off. Start looking into Argentina stocks. So the easiest way to do this is that you can just go type in Argentina stocks on the USA market, of course. So here we see our first opportunity in BMA stock. This one, like I showed you, of course, you first measure using 1.5 and then see where you could have sold. But here you could have gotten a 6 to 1 win trade. After that, checkout. So we see the checkout that happened in the primary market while this one is correcting to the 20-day. This one is correcting to the 50-day. Then a second kind of cup with a handle there. You could have gotten a second trade. This second trade was not that great because honestly, you want this trade which just take about 2 weeks, right? And you're out of the trade, 2 to 3 weeks. But this one probably took a month, so it kind of wasted your time. SUPV, which is an Argentina bank too, you can see it forming a very similar pattern to the previous one. So these stocks always follow similar patterns. That is why you'll feel very safe buying a bunch of them. So the first one, a smaller trade. This one, the first one gave us 6-1, but this one didn't give us that opportunity here. So not all the stocks are going to acting exactly the same, but they're going to be rhyming. Then it gave us another great opportunity here. Comes here, forms a chit, breaks out again, forms a very big move. Of course, as a trader, you're not going to be getting this huge move, which was probably 100% move. You're going to be getting just a 6-1 trade, but that's the price you have to pay for getting in and out quickly. Because an investor could have bought here in July, and they had to wait till about 8 months to get their 100% return. But for you, you're going to get your 40% return in just 3 weeks. So that is the advantage as a swing trader. YPF, which is in the same thing. I show you the several trades you had here. Of course, you're not going to get this 80% move, but you could have gotten several wins here as a trade. So it also helps to know where you are in the stock cycle. So if you know that this is a very good setup and it's good as an investment play, then you would want to hold it for a long time. So for me, I actually have 2 accounts. I have a swing trading one. I have a long-term investing one. So when I see a setup like this, I will normally not just swing trade it. I will just put it into the investment account so that I can get these huge moves. But I'm just trying to show you that even as a swing trader, you could have gotten these moves, and I'm also trying to show you that these moves are just part of a bigger stock cycle. And what you don't want to be doing is switching from one to another. So don't be switching up between 50, you're doing this swing trader plays and then you turn into an investor later. That is going to really hurt your account. So you already just want to be one or the other. You should only do that if you really are a pro and you really know what you're doing. You've gotten like 6 years of experience. And the last example is China stocks. So we see here the HSI index, which is the China stock index. We see it bouncing off the 20 days several times, and we see a huge move like this. So what we can do is now we go into the particular stocks and see which ones have good setups. So here we see JD stock comes in. A good thing that I learned is that stocks never just rise above a falling day, a falling 50-day simple moving average. What they normally do is they will just form a chit around it, or they will pass it and then correct and then go up again. So here we see that we have our closing price reversal. Like I already told you, moves about the 20-day, and then we do our calculations. Like you already know how to do the calculations. Here you get your easy 4-1 win. FTSE stock had 2 opportunities, right? Out of those 4 times the market was bouncing, you had this first one, which was a 5-1 win. It already forms these small chits here. Several opportunities, right? But I don't like it when it's under the 50-day simple moving average. I always want to be buying above. So we see it forms this chit here, closing price reversal. We get in on that day. Boom, get your good return, 5-1. Next one, closing price reversal, right? You can see that this, although it's a red day, the fact that it closed above the high of this previous day. The next day it gaps up, we just buy just straight in the morning. Don't waste time. This is a very huge sign. Gap ups just mean everybody's on the same side of the market. You get your 7-1 win. And why did you know that this was going to be a bigger move? It's because we saw in the primary index that it was coming off a correction. This is off a bear market, so you expect kind of a bigger move. TCOM stock had 2 opportunities during that time. I try to show you the weekly charts on all of these. So you want to see that at least 3 to 4 week consolidation. You see it here, forms your closing price reversals. You get your first trade. You're not making the whole swing trade, right? Only the investor could get this whole move easily, but they have to pay a price because you see it crashed and they would have to maybe sell around $50 then. The investor is not going to know that, hey, let me sell here at $58. So they also have their own disadvantages, but they can catch these bigger moves. For you as a swing trader, you're going to get this first one, 5-1. Then you're going to get this second one, 4-1 trade. And then there could have been one you could have squeezed here, but it was a little bit risky. I'm not seeing a very good setup, right? And that is all. I hope you enjoyed that video. I showed you everything that you need to know about this particular strategy. Of course, I want you to watch my other videos so that you learn more about the technical aspects. And may the markets be with you. Thank you.